Moats. An economic moat is a company's long-term competitive advantage that protects it from rivals. These are companies that are durable and have strong defenses in the market. There are 5 common types of economic moats: brand power, selling at a low cost due to scale, network effects, switching costs, and legal moats, which is when a company is largely protected by patents and licensing. Coca-Cola has many strong moats. It is recognized and distributed around the globe and has loyal customers built over a century. Most people would rather drink Coca-Cola over other cola brands because of its familiarity and not its taste. Investing in strong management. A company can have a great product but fail remarkably. Buffett looks for companies managed by intelligent and competent leaders who are honest and act in the best interest of the company and all the shareholders and consumers. The manager must be able to grow a business and be financially wise. They must have integrity and gain the trust of shareholders by not hiding any risks. They must be disciplined in not overspending and avoiding wasteful decisions. Everything they do must feel objective and truthful. Bad management will look something like this. Stick to what you know. Focusing on companies that he's knowledgeable in gives better judgment. It lets him assess the risks and opportunities and the competitive edge a business might have over others within the same industry. Buffett calls this the circle of competence. He must first understand how the company makes money, who runs the company, and its competitive landscape. Investing in areas of deep knowledge allows him to avoid speculation and noise, and can then make critical and intuitive judgments by himself. Diversification. Diversification can be very powerful for most investors, especially if you're an amateur. If you know nothing, diversifying lowers the risk if a company performs bad, as that one bad investment will average out. Companies can be personally selected or picked automatically through index funds such as the S&P 500. Buffett, however, does not overly diversify, as he has deep knowledge and trust in a select few companies which he'd rather concentrate on. This leads on to concentrate. Spreading investments too thin can dilute and flatten out returns. Although it is safe, Buffett prefers to focus on only a few high-quality investments. Coca-Cola and Apple are companies he will defend to the grave. He deeply understands them inside and out and knows their value is much stronger than their competitors. The business model. Understanding the company's business model means you should know exactly how that company makes its money. What does it sell? Who are its customers? Why do people keep buying from them instead of someone else? He likes businesses that are simple, consistent, and easy to explain, like Coca-Cola or Apple. If you don't fully understand how a company operates or how it plans to keep growing, it's a lot harder to tell if it's a smart investment. Buffett avoids companies that are too complex or outside his area of knowledge. His approach is simple: only invest in businesses you truly understand. That way, you're not just guessing and are making informed decisions based on real knowledge, not hype or hope. Value over price. Price is what you pay, value is what you get. Points out that just because something is cheap doesn't mean it's a good deal, and just because it's expensive doesn't mean it's overpriced. The price is just the number you see, but the real question is, what are you getting for that price? A strong, growing company might be worth a lot more than its current stock price suggests, so instead of focusing on price alone, Buffett looks for real value, solid businesses that are worth more than what they're selling for. Don't time the market. Trying to guess when the market will rise or fall is nearly impossible to do consistently. Even professionals often get it wrong and becomes casino gambling at this point. Instead, he insists one must be disciplined by staying in the market for a long time. Not only is timing the market very risky and time-consuming, but means you'll miss out on major upswings. The S&P 500 may be slow, but in those years you are bound to hit some lucky days. Buffett prefers to invest in predictable companies like consumer staples, insurance companies, and railroads because of their predictable earnings and their reliability to society. Fear and greed. Be fearful when others are greedy, and greedy when others are fearful, is about staying smart and calm in the stock market. When everyone's excited and jumping in, prices can get overinflated, and that's when you should be cautious. But when things look bad and people are panicking, that's often when the best opportunities appear. It's not about reacting emotionally, it's about thinking long-term and doing the opposite of the crowd when it makes sense. In short, don't get swept up in hype or fear. Focus on value and make thoughtful decisions. This leads on to avoid emotional decisions. Don't let fear or excitement control how you invest. The market goes up and down, and it's easy to panic and sell when prices drop or get greedy and buy when prices soar. But reacting with emotions usually leads to mistakes. Instead, Buffett says to stay calm, stick to your plan, and make choices based on facts and logic, not feelings. That's how you avoid costly errors and become a smart investor. Know when to sell. Knowing when to sell means you shouldn't just sell a stock because its price goes up or down. Instead, you should have a good reason to sell. Buffett likes to hold on to great companies for a long time, but if the business changes, like if its products stop being popular, management messes up, or the company's future looks worse, that's when you should think about selling. Also, if you find a much better opportunity, selling might make sense. He doesn't believe in constantly buying and selling just to chase short-term gains. The key is to stick with quality investments unless something really important changes. Margin of safety. Margin of safety is like a cushion. It is good to invest in stock when it is below its believed long-term value. This is the intrinsic value of a company and requires some experience to be able to judge. The margin gives some wriggle room for poor judgments. Buffett calls it the 3 most important words in investing. He saw this as doing one of 2 things: avoiding losses and going back to square one, or buying shares in a valuable business at a low price. Keep cash on hand. Don't put all your money into investments. It's smart to have some cash ready so you can jump on good opportunities when they come, like buying stocks when prices drop. Having cash also means you won't have to panic and sell investments if you need money quickly for emergencies. Think of cash as a safety net that gives you flexibility and peace of mind. That way, you're not forced into making rushed decisions and can take advantage of chances when they show up. Be cautious of leverage. Be careful about borrowing money to invest. Sure, leverage can boost your profits if things go well, but if things go badly, it can backfire in a big way. You could lose more than you put in and still owe money. Even a solid investment can turn into a disaster if it's built on too much debt. Buffett prefers playing the long game with money he actually has, rather than taking big risks with borrowed cash. His view is simple: don't risk what you need for something you don't need. If you're wrong, leverage can make the consequences much worse. Taxes. It's really important to know how taxes affect your investments. Taxes can take a big chunk out of your profits if you're not careful. For example, short-term capital gains usually get taxed more than long-term gains. Dividends might also be taxed differently depending on the situation. Buffett suggests learning how these rules work so you can make smarter choices, like holding onto investments longer to pay less tax or timing your sales better. Understanding taxes helps you keep more of your money and grow your investments more efficiently over time, instead of giving away more than you need to the taxman. Compound interest. Warren Buffett started investing when he was just 11 years old, and he often says that one of the biggest reasons for his success is the power of compound interest. Compounding is when your money earns returns, and then those returns start earning more returns. It's growth that builds on itself over time. Buffett believes the real secret to wealth isn't flashy trades, but letting money grow steadily for decades. He always says those who understand compounding will benefit from it, and those who don't will lose out. His advice: start early, stay patient, and respect compounding. Don't be wrong. All it takes is to get a few moments right to get lucky with investments. Because of the chaotic nature of the universe, it's easier to just avoid getting things wrong rather than getting things right. Making a not-to-do list is more important than listing ways of beating the market. Don't be wrong. Simplicity. A lot of investors get caught up in complex formulas or big economic predictions. Buffett avoids all that. He focuses on just a few key things. Is the business easy to understand? Does it consistently make money? And is it run well? That's it. He said before that people make investing harder than it needs to be. For him, the simpler the better because it's easier to stick with, and you're less likely to mess it up when things get bumpy.